Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at earnings reports from some of the world's largest retailers.
Plus, a look at why the Danish drug maker Novo Nordisk will be further lowering the prices of its obesity drugs for cash-paying patients.
But first, we'll begin with earnings from chip giant Nvidia.
This week, the company reported third-quarter earnings that topped analyst estimates. Nvidia also delivered a surprisingly strong revenue forecast and pushed back on the idea that the AI industry is in a bubble.
For more, we were joined by Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst. We first asked Kunjan for his take on Nvidia this week.
This was one of the more bullish earnings we have seen from this name in a while, not just on the numbers of the 3Q, 4Q guide, which they blew past even the loftiest buy-side targets, but just beyond that, the long-term, the 26 sort of, and going into 27 demand signals that they showed, namely the $500 billion of the pipeline, which we think now is a conservative number, given the number of deals they have announced. So if supply keeps on coming up as it has, and if their customers continue executing on these bills without any missteps, we think there's significant upside to the current street numbers.
Yeah, just looking through the numbers, clearly a beat and raise report, but the scale at which it can beat and raise is impressive. Although within the third quarter numbers, I did see that chips used in gaming PCs missed analyst estimates. And I know that that's a shrinking part of the business, or at least it's not as big a part of the business, given that the data center is where the growth is really at. Are there any flaws in this earnings report, Kunjan?
Not really. I mean, look, the gaming is becoming so unimportant for analysts that the reliability of or the predictability of those numbers against which we're comparing the beat and miss for gaming is no longer as reliable. So no real flaws to really point out in this. We did see their supply commitments go up quarter over quarter and inventories rising. I don't think that's a negative, while it might seem on the face. That's just them gearing up and getting ready for that next wave to supply the chips in the next year.
So, Kunjan, what's the latest from Jensen Huang about how he views China going forward?
Nothing has changed on the China side. They still don't assume any revenues when it comes to data center, AI, China GPUs, or the H20 is being shipped into. They do have the clearance licenses, so they could, but it seems because of the geopolitical issues, China has basically been shut down for American GPU providers or ASIC providers to be able to ship in the country. There is, to be honest, no demand. So it seems, because of geopolitical issues, the customers in China are not just ready and getting up to buy NVIDIA chips right now.
Jensen Huang said that he, from his vantage point, does not see anything like an AI bubble. We see something very different. And he says competitive pressures remain fairly low because this is a company with more than 90% of the market for those high-end, super fast AI chips. Who is the closest competitor, if there is one, to NVIDIA?
Yeah, in terms of the size of the markets, the next closest competitor would be the AI ASIC chips. So Broadcom is one of the biggest providers of AI ASIC chips, namely the TPU that Google uses. Another example would be Amazon's Trainium chips, which a different AI ASIC designer supplies. So in terms of revenues or units in terms of the market, those are the next closest competitors. Within NVIDIA's realm, which it sells merchant GPUs, AMD would be the second closest competitor in that.
Our thanks to Kunjan Sobhani, Bloomberg Intelligence Senior Semiconductor Analyst.
We continue in the tech space.
This week, we heard that the tech giants Microsoft and Nvidia are committing to invest up to a combined $15 billion in the AI research and development company Anthropic.
We heard the investment will be part of Anthropic's next funding round. The company's also said Anthropic has committed to purchase $30 billion of computing capacity for Microsoft's Azure cloud service.
So, of course, we had to enlist Mandeep Singh, Global Tech Research Head at Bloomberg Intelligence.
We first asked Mandeep to tell us a little more about Anthropic and what it does.
Well, Anthropic is one of the 5 frontier LLMs that are remaining. I mean, and they are leading the charge when it comes to generative AI. So it's one of the 5. The other one are Google, OpenAI, Meta, and XAI. And so, look, when it comes to these commitments, it's pretty obvious that OpenAI has raised the bar by announcing they're going to spend $1.4 trillion. So the question is, what are the other LLM companies going to do? And Anthropic is also a pure play LLM. And in their case, they don't have the funding. I mean, they don't have the balance sheet like Google or Meta have. So they have to raise the money either in the private markets or from someone like Nvidia, or get into an agreement with Microsoft, which also has an agreement with OpenAI. So that's where, LLMs need compute. That's how you serve billion plus users. And that's where, the numbers get bigger and bigger when it comes to tie-ups with cloud providers.
This is like the popular clique in high school where everyone knows each other and everyone's messing around with each other. Just give us a little bit of background here on Anthropic, because my understanding is that it was founded by folks who used to work at OpenAI, and some of the early investors, like big stakeholders, include Alphabet and include Amazon, and now you've got Microsoft in there. I mean, is there anyone who's not part of Anthropic and not committed to investing in this company?
Well, you could say Meta. They're doing things.
They're doing their own thing.
They're doing their own thing in terms of using the compute internally, and they don't have a cloud business.
Is that a problem for them that Meta's out there on its own? I know it doesn't have its own cloud business, but it's not buying stakes or committed to invest up to $5 billion or $10 billion in any of these AI companies.
I mean, so far, just to go to Meta, it feels like, investors were okay with them using the GPU compute for their own family of apps. But the fact that they're talking about 100 billion plus in CapEx for next year without having a substantial ROI, and what I mean by ROI is in the case of Microsoft, yes, they are raising their CapEx to 120 billion, but they're winning deals like the one with Anthropic, $30 billion in commitment from Anthropic. So somebody is paying for that compute in the case of Microsoft. You don't have that with a Meta. How are you generating ROI outside of your family of apps? And over there, you have to show a really substantial increase in engagement to convince investors it's worth 100 billion plus in CapEx.
Any of these OpenAIs, Anthropics, are they going to ever come public, do you think?
I mean, in the case of Anthropic, look, I know the numbers are getting big, but their gross margins at this point are probably better than OpenAI, which is doing too many things. I mean, the biggest risk I see for OpenAI is they feel they can get into any business, whether it's chip business, whether it's, obviously LLM is their turf, any type of applications. And that's where there's a possibility of a misstep. You can end up wasting time because you just don't have the capability. Yeah, the focus. Whereas Anthropic is more focused.
Our thanks to Mandeep Singh, Global Tech Research Head at Bloomberg Intelligence.
We move next to some earnings from some of the world's largest retailers.
This week, Target posted a drop in third quarter sales due to intense competition and a weakening economy, with shoppers pulling back on apparel and home goods.
Separately, Walmart reported third quarter earnings that beat analysts' expectations. The retailer also increased its outlook for sales in the full year. It's a sign Walmart is winning over price-sensitive shoppers while digesting costs it expects to rise in the coming months.
For more, we are joined by Jennifer Bartashus, Bloomberg Intelligence senior analyst covering retail staples and packaged foods.
We first asked Jen for her take on the most recent results at Walmart.
Walmart had another good quarter, and I think that it's very easy to attribute a lot of their success to just the value-seeking behavior of consumers in this environment. But I think that would also be overlooking a lot of the investments they've made in things like convenience. That is really spurring the e-commerce growth, and that was really a notable takeaway.
Yeah, that e-commerce aspect helps draw in higher income shoppers, so it's a larger pool of customers that Walmart now has access to. And in our Bloomberg News reporting, we indicate that the digital offerings now include luxury items like pre-owned Chanel bags. I had no idea that kind of stuff was available on Walmart.com.
Well, Walmart has done a lot to really expand its marketplace, and that includes bringing in items that, will appeal to that higher income consumer. And the tactic behind all of this is that the more people are integrated with e-commerce in going to stores, they become sticky and they become loyal customers. so that when the macroeconomic backdrop fades, it really increases Walmart's ability to hang on to these customers going forward. And that just drives future growth. So it's a really interesting play out of how they're applying that tactic.
Jen, I also want to get your take on Walmart transferring its listing to the NASDAQ. That's going to happen on December 9th. And that, of course, is to reflect its focus on being a tech-forward company. But I'm wondering, I mean, how much of this is really just about being included in the NASDAQ 100 and therefore the QQQ ETF?
Oh.
Yeah, there's certainly part of that, Scarlet, where, that's probably part of the motivation. I think that there is, obviously there's a perception with regards to being perceived more as a tech company, which Walmart, in all truthfulness, has evolved into a tech company, especially amongst other retailers, by being listed at NASDAQ. Long term, maybe it helps their valuation, just in terms of having that perception of being more, aligned with peers. Amazon is listed on NASDAQ. Things like that. So I think that there's a lot of those components together, combined, are really behind the move.
Jen, nobody arguably has a better finger on the pulse of the consumer than Walmart. What are they saying these days?
Actually, they seem relatively optimistic. They talk about, spending holding steady for kind of that middle-income consumer. High-end consumers seem to be spending pretty freely. A little bit of concern about some of the lower-end consumer, but it does seem to be sort of evening out. And so when they were looking forward to the holiday season, which is the most important thing with regards to the retailers that I cover, they seem cautiously optimistic that there will be a pretty good holiday season this year. We do think that people will prioritize spending on kids. That's usually what happens first if they're holding back in other parts of their budget. But all indicators right now seem that we're headed towards a reasonably solid holiday season.
Our thanks to Jennifer Bartashus, Bloomberg Intelligence Senior Analyst covering retail staples and packaged food. Coming up, we'll take a look at why the global payments services provider Klarna reported record revenue in its first quarter since going public.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to earnings from some of the world's largest home improvement retailers.
This week, Lowe's reported third quarter profit that topped analyst estimates. This was a result of online sales and demand from professional contractors.
Separately, we heard from Home Depot, who cut its full-year guidance. This comes as a company warned that some unsteady consumers are hitting the pause button on big-ticket home purchases.
So we spoke with Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
We first asked Drew to break down this week's results from Lowe's and how they compare to Home Depot's.
So I think Lowe's results could be best characterized as better than feared, particularly in light of what we heard from Home Depot. They did fall short of consensus estimates on same-store sales, but I think the buy side was probably looking for something flat to lower, so a little bit better than they were looking for. Now, that being said, they did trim their full-year outlook. Now they're looking for full-year comp sales to be flat from flat to up 1%, so that would imply that 4Q is relatively flat, but similar to what we heard from Home Depot, they had about 100 basis point impact from hurricane activity that was not replicated this year. So again, if you were to back that out, it looks like the underlying trends in the business are pretty stable. That being said, they're still grappling with the same consumer uncertainty and, the same weak housing market that their competitor is. So, still challenges out there in the market.
Drew, I think I understand it correctly that Lowe's has a lower percentage of sales to professional contractors than does Home Depot. If so, are they trying to narrow the gap? Are they targeting that segment a little more?
Yeah, great question. So Lowe's is about 30% professional contractors, 70% DIY. Home Depot is about 50-50, maybe even a little bit higher on the pro front. What's interesting, and to your point on investment, is the pro space, especially in building products distribution, has really become a battleground among home improvement retailers. You had Home Depot recently do acquisitions for SRS and GMS, and then you have Lowe's, who recently acquired Foundation Building Materials. So it's certainly an area where they're making a concerted effort to grow. Now, Lowe's has historically focused on the small and medium-sized pro. And what this acquisition does is it gives them exposure to larger pros who do more complex projects. So they're able to, be the supplier of choice across more building product categories and at a larger scale.
So basically directly competing with Home Depot in many ways. Is this going to become a duopoly, or are there still a lot of other places that professional contractors can go to?
Yeah, so the building products distribution space is still very highly fragmented. I wouldn't be surprised to see further consolidation within the industry, across different categories. Home Depot and Lowe's are certainly, two of the behemoths in the industry who have, the scale and financial flexibility to further consolidate the industry. But there's some other players as well, like QXO. So it is a fragmented industry, but I would expect, in the coming years, it's something that continues to get consolidated.
I can't keep track of where all the tariffs are these days on all the different products, but I'm just guessing if I'm a Lowe's or a Home Depot, my plywood from Canada, that's probably being tariffed. A power tool from somewhere in Asia, that's probably subject to tariffs. How are these companies dealing with it? What have they been telling you guys?
So Lowe's gets about 60% of its products from the U.S. So their exposure internationally is maybe not as high as you would expect. China is probably around 15 to 20%. There hasn't been a whole lot of talk. I think we have seen their average ticket increase this quarter. It was up about 3%. And part of that is in response to tariff-related price increases. Lowe's told us that they were only modest increases. And, they'll take a portfolio approach to how they increase prices. They'll look at their product lineup and see where they have more elasticity. But I think the impact of cost will start to come in a little greater as we look into Q4 and early 2026. And, some of the areas that we're looking at, you mentioned plywood, so lumber tariffs from Canada. We also had the implementation of tariffs on cabinetry, both kitchen and bath, which could go up to 50% in January. So I do think that the impact gets a little greater as we look at the next year. So I would expect further price increases from both retailers.
Our thanks to Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
We move next to third quarter earnings from the global payment services provider, Klarna.
This week, Klarna reported record revenue that beat analyst estimates on Wall Street. The firm also set aside more provisions for credit losses in its first set of earnings since going public.
For more, I was joined by Anthony Hughes, Bloomberg Equity Capital Markets reporter. I first asked Anthony to talk to us about Klarna's most recent results.
Yeah, well, Klarna is a company that's actually been around for about 2 decades.
Okay.
It's just that since about 2019, they've really expanded quickly in the US. And Buy Now, Pay Later is a lending/payments product, which basically allows people to, buy products and obviously pay for them over time. And this is an alternative to the credit card option. So really, a lot of Klarna's growth really reflects the fact that this product's becoming more popular relative to credit cards. And for a lot of consumers, it's a good way to manage your cash flow and, you obviously buy a product and not have to pay for it over time. And that suits a lot of people. And it is a fast-growing part of the fintech or, say, consumer lending space. Yeah. And obviously,
so as a consumer, how does Klarna make money on my $100 purchase that I put on their system?
Yeah, well,
they charge me interest?
No, well, there's a number of different products. That some of the longer-term lending products do have interest associated with them, but that pay in 4 product they talk about, which is paying in 4 installments over a few months, that is an interest-free product. And really, the source of revenue in that instance is from the merchant, and merchants pay a merchant service fee. It's higher for them. It's higher than they pay on a credit card transaction. But basically, they see the benefit of Klarna bringing in extra customers so they can sell more product. And people will ask themselves, well, who actually pays the merchant service fee? Well, the merchant does pay that to Klarna, but the merchant does incorporate that as a cost of doing business into the products that he sells to you and I. So we, in a sense, we all pay for the fees that are hidden within the payment system, and really merchants pass on to the consumer depending on how you pay the
interesting.
You pay for your product.
Who's a typical Klarna consumer out there? Like what's kind of a typical transaction for a buy now?
Yeah, well, these are mainly small transactions of can be a few $100s or not large transactions, and this obviously suits a younger audience, and that's where a lot of the a lot of their customer base has come from. But they've built a large business which globally has something like 110 billion of what they call gross merchandise volume, and that's it's a fast-growing business in the US. It's been growing pretty fast for them, 40-50% in this recent quarter. And obviously there's a couple of other companies that are in this area as well. So it's a competitive area as well with Affirm, which is another company that went public perhaps about 5 years ago.
That was Anthony Hughes, Bloomberg Equity Capital Markets reporter.
We move to some news in the biotech space.
This week, we heard that the Danish drug maker Novo Nordisk will be further lowering the prices of its obesity drugs for cash-paying patients.
It's in an effort to claw back a larger share of the U.S. market from arch-rival Eli Lilly. Novo said introductory doses of its blockbuster drugs Wegovy and Ozempic will be available for $199 a month.
That price applies to the first 2 months of treatment. After that, Novo will offer the drugs through its NovoCare direct-to-consumer portal for $349 a month. That is 30% less than the current self-pay price.
For more, we were joined by Michael Shah, Bloomberg Intelligence Senior Pharma-Biotech Analyst. We first asked Michael to break down what exactly Novo Nordisk is doing.
And this is obviously ahead of the White House deal. So you're seeing starting doses being reduced to $200 per month, and then doses thereafter being charged at an average of $350 per month compared to $500 previously. So, I mean, those prices kind of align to, the pricing in the White House statement coming from Trump RX. But compared to Lilly, I mean, they're undercutting them by about, $100 at each dose. And this is basically a ploy to basically compete for new patient starts. As we know, Lilly's got the more effective product in terms of weight loss profile. And they're also, executing better on the launches. And I think that's clear from 3Q results, where we saw contrasting fortunes between those two particular drug makers.
Mikey, give us a sense of this marketplace here. What percentage of the addressable market is actually taking these obesity drugs versus, because it seems like as the price comes down, more and more people will be able to get access to them?
Yeah, absolutely. I mean, it's a highly price sensitive market. When we look at penetration rates in the US, low single digits, that's obviously going to accelerate as these drugs become cheaper. Looking outside the US, penetration rates are even lower. So there's, still significant kind of, patient runway out there. In terms of US penetration, I mean, the White House pricing deal on GLP-1 drugs, supports kind of use of these GLP-1 drugs in Medicare. There we think that it can unlock 7 to 8 million patients, according to a White House statement. I think they said 10% of Medicare beneficiaries would become eligible for GLP-1 drugs based on the pilot program that's going to be introduced in 26, and I think it's going to become mandatory in 27. And then they've also, lowered the price in Medicaid too. I think the uplift in terms of patients there is a bit harder to deduce or to kind of model, given that coverage is going to be on a state by state basis, and there's also kind of different qualifying criteria, which again is state dependent.
What does this mean, Michael, for the companies like Hims and Hers, the companies that make compounded copycat versions of these anti-obesity drugs? They've done very well, and I know the stock for Hims and Hers has been kind of all over the place, but it is modestly higher from where it was at the start of the year.
Yeah, I mean, I think that whole, the compounding situation, I believe that, 1.2 million patients are on compounding GLP-1 at the moment. That's based on kind of comments that Novo made during their 3Q results. Obviously, lowering down the price would kind of the branded treatments would basically, well, I mean, it would lessen the delta between, copycats and branded treatments. So I guess it's a negative for these, compounded GLP-1 drug makers.
Mikey, when I look at the big cap pharma names, is it as simple as I want to own the ones with exposure to obesity market and not own the ones that don't? Because I'm looking at your slate of stocks, and you're either up 30% or you're down.
Yeah, I mean, I think there's a few large pharma names which have entered the space. In the recent years, you've seen kind of deals with Roche and Zealand for an amylin drug. Most recently, you've obviously got the Pfizer Metsera M&A deal.
Yep.
I mean, I think obesity is obviously appealing given, the size of the target population, how underpenetrated it currently is. And, if you're looking to, offset patent expirations later in the decade, there's an abundance of kind of GLP-1 products out there, as well as other assets too. So I think that's the appeal of the space. It's a large market, it's underpenetrated, and there's high demand for these treatments too.
I mentioned M&A, and of course we know that J&J is making a purchase to increase its pipeline to get away from relying on these older drugs that have lost patent protection. Is every pharma company doing the same thing? Is that, their not only strategy, but is that the way they move forward? Is there anyone who's kind of like in a good position and doesn't need to make a deal?
I mean, I think that's always been part of the large pharma model. They supplement kind of in-house innovation with external innovation, particularly if they want to get into areas perhaps outside of their core competency. But I mean, I think that's just the model in general. Biotech's always been the pipeline for large pharma companies, or at least help bulk up their pipeline.
Our thanks to Michael Shah, Bloomberg Intelligence Senior Pharma-Biotech Analyst. Coming up, a look at why the global sports company Amerisports raised its full-year guidance.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence through BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to earnings from the department store TJX.
The off-price retailer reported third quarter sales that beat analyst estimates. It also raised its guidance for comparable sales this year.
It's a sign that U.S. shoppers are turning to cheaper options as the economy shows signs of stress. For more, we were joined by Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst.
We began by asking Mary for her take on this week's results and whether she is a fan of TJX.
I'm a fan too, and it's because they carry such a variety of brands and it appeals to all income groups. So if you have a luxury consumer, you can get Balenciaga, you can get Chloe, Lowe. So they carry all of the brands. And then if you're more pressed and you're really a value consumer, they have Steve Madden, they have Theory. So they have Puma, they have Nike, Adidas. So they have all the brands that consumers want, and that's why their Marmax, which is TJ Maxx and Marshall's division, reported a comp sales increase of 6%. So, and that's why, if you look at the overall results, they were up 5%. So a lot of strength there within the Marmax home goods. And of course, Canada was up 8%. So we're seeing consumers flock to get the brands that they want, and they've had some amazing buying opportunities, so their margins were higher.
So the way that TJX stocks its stores is that they get inventory that hasn't sold at full price stores. But if all these merchants, all these retailers are managing their inventories better and don't have a lot of excess inventory, where does TJX get its inventory? I mean, it has to have another option, right?
Yeah, Scarlett, you raise a good question, but the fact is that some of the retailers, but also the brands themselves. So if you think of, for example, PVH, which has the Tommy Hilfiger and Calvin Klein brands, we see those brands pretty prevalent throughout off-price. So that's been a good channel for them to sort of release some of that excess inventory. And when they work with some of their wholesale partners, including the department stores, so where you have product that's not selling, off-price is just a natural fit to be able to release that inventory. So you want to keep your inventory fresh in the stores, especially when you're a full-price operator. And there hasn't been any slowdown in terms of that excess inventory. And that's why even on the luxury side, where typically you wouldn't think you'd find markdowns, it's been pretty prevalent, especially with overall weakness in luxury.
So what is the folks at TJ Maxx, what are they saying about the consumer these days?
Well, the consumer, I mean, they're really seeing strength. So it's interesting because when you sort of read the take on Target with their results, and they sort of cited, the consumer is very cautious. But that caution, I think what's really going on is that they've got the brands that consumers want. So those that are executing are the ones that are getting the sales, because even some retailers that are more full price oriented are generating sales, or they may be promotional. So the consumer is flocking to value, there's no doubt about it, but we do see some, operators. You've got Ralph Lauren on the luxury side. They continue to outperform, and their sales are always topping expectations too. And consumers there are willing to pay full price. So they're a lot less promotional. Every year, they seem to be less promotional. For that reason, they're able to sell at full price.
So clearly, TJX has a strategy that works well given the current environment. And even when the economy is doing well, I would argue it has a strategy that works well. At what point do investors want more from the company than just executing on the strategy? will they want, I don't know, M&A? Do they want consolidation? Do they want innovation from TJX?
Yeah, well, so that's the reason why TJX is focused, internationally. So they're going to be entering Spain in 2026, so coming next year. And of course, they've had they have 2 joint venture investments, one in Mexico and then one in the Middle East. And they're both off-price retailers that they've invested in. So they're basically taking their talent and providing them a platform to leverage their talent in these joint ventures and to grow that way. So they're always looking for ways, because Scarlett, you bring up a good point. TJX trades at a pretty high premium in the off-price space, and generally it's a pretty big premium. That is due to their very consistent execution. But you're right, consumers keep wondering, well, how can they keep growing on top of all this growth? And yet they keep doing it. But as they talk about, look, they have drops several times a week. There's not a lot of retailers that offer fresh merchandise several times a week. And they curate the merchandise by location. So they're very cognizant of the demographics for each location.
Our thanks to Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst.
We move next to news from the global sports company Amerisports.
This week, the company raised its full-year guidance for the 3rd time this year. That's after strong demand for its Salomon footwear drove quarterly sales to a record.
Sales growth at the group's other 2 units, including the technical apparel segment and the ball and racket sports unit, also surpassed estimates. And overall group sales, they hit a new high.
For more, we were joined by Abigail Gilmartin, Bloomberg Intelligence athleisure and footwear analyst on Amerisports earnings. We first asked Abigail to break down Amerisports' most recent earnings report.
They did really well, sales up 30%, broad-based strength across regions, across channels, and across brands. I think the key thing people were looking for was China. Arc'teryx recently had some controversy in China with a fireworks display in the Himalayas. Fireworks display.
Who displayed fireworks in the Himalayas?
Arc'teryx for set off fireworks.
Why?
Exactly. It was definitely a misstep for an outdoor brand that's really focused on sustainability. And there was definitely some concern that there would be a little backlash in China. There's definitely a lot of people upset about it, and they were fined by the Chinese government and working to restore the ecology there. But Greater China was up 47%. Momentum is continuing into 4Q. So I think that was really a big takeaway, just quelling investors' concerns about potential backlash in China, especially because they're the #1 outdoor sports brand in China, Arc'teryx. So it's a big market.
I had no idea that they house such strong brands. I mean, Amerisports on its own is kind of, it's not memorable, the name, the parent company name, right? But the brands, of course, are Salomon, Arc'teryx, Wilson, as you mentioned. What does the tariff picture look like for this company?
Yeah, I think it's very similar to most of the other companies. I think for them, what benefits them is their premium positioning. They're able to raise prices and they're not seeing any backlash from consumers or pullback. They're still seeing very strong full price sell-through. So they're able to offset some of those tariff costs with that, which I think is really helping. And we're seeing that with a lot of more of the premium brands are able to kind of navigate through the tariffs since their consumers are willing to pay a little more.
Upper K of the K-shaped economy.
I guess, I know. That's, I guess, where you want to be there. Talk to us about the footwear market here. I think, Nike, Adidas, all that kind of stuff. What's going on there?
Yeah, I think, we're in store for a very interesting holiday season. I think that we're going to continue to see the premium brands continue to do well. On Holdings recently just reported and did phenomenal. And they also said they're not seeing any backlash on raised prices, and they'll continue to do, limited discounting through the holidays. So we may see some differences between the two companies, but we just had our recent BI survey, and Nike continues to lead. I think there's been concerns over Nike, but they still are the major shareholder and still a favorite brand of millennials, Gen Zs, everyone for the holidays. So they should continue to do well too.
What is Amerisports' distribution strategy? Do they have a DTC offering, or are they going through third-party retailers?
Yeah, that's a great question. So it's a little different for each brand. For Arc'teryx, they're leaning a lot more into DTC. They've changed their distribution strategy from basically 80% wholesale to 80% DTC over the last 3 years. And they're really focusing on growing their store base, because I think not a lot of people know about Arc'teryx. It's really going to help the brand awareness. So even in the US, they're looking to double their store count by 2030. So that's that. Through Salomon, continues to be wholesale, especially for footwear. We're seeing this holiday season, consumers strapped for cash. They're wanting to go into the stores and try on their shoes and make sure it's the right fit and buy them versus, buy 5 pairs and return them.
Yeah.
So the wholesale distribution for Salomon is really key, and they're in a lot of key premium partners, I would say, and the running specialty stores as well.
I mean, I'm looking at your report here, research report on the sneaker business. I didn't know there were so many shoe manufacturers. I mean, Nike's the dominant one, as you said, but there's like 14 in your survey here.
Yeah, and that's
a competitive marketplace.
Definitely. It's getting even more competitive as consumers with AI, technology, there's just such more of a breadth of discovery. So that's where product is really coming into play this holiday season, I think, innovation, product, and style.
Abigail, if there's one thing to be worried about when it comes to Amerisports, what would it be? I mean, what's an area that they're not executing on?
So I think the China thing was the one uncertainty for this quarter that we were it could have gone either way. So that would be the biggest thing. But honestly, they're executing on most of their things. Their biggest drivers are DTC, women's, and China, and all of those were up double digits and more. And they're really gaining share in women's, which I think is a big new opportunity for them as more women join the outdoor market.
All right. Which have you purchased in the last 12 months, sneaker brands? For baby boomers. Skechers.
Yeah.
What?
Yep. Skechers continues to win.
What is that?
Honestly, they're so comfortable. They're like the price point, the quality. I know, but you'd be
that
surprised.
Is not something that they market out there, that they put out there. Either,
no, and
right?
they're the 3rd largest footwear brand globally.
Really?
Yeah, I think right behind Adidas.
Next, you're going to tell me that the boomers are using the shoes with the little wheel in the back.
The wheelies. The wheelies.
Yeah, no, they're doing the step-ins. You don't even have to bend down for your shoelace. That's it.
That's what I think it is. Okay, I think you're right. All right.
I mean, yeah.
There you go. I mean, the kids, the Gen Z, the millennials, they're still in that Nike brand. That Nike brand still... And Adidas.
Or Hoka's.
Yeah,
right?
Hoka and On are gaining, but they're still small. And I think people don't realize that just because there's been such a big boom. They're still very West Coast, East Coast oriented. They still have a lot more room to grow brand awareness in the US, especially in the middle of America.
That was Abigail Gilbert, Bloomberg Intelligence athleisure and footwear analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.